Hello friends, this is Gospel FX Trader. Welcome to another in-depth video lesson. In this short video, I'm going to be showing you guys how to differentiate between liquidity gap and break-off structure. I know this has caused a lot of confusion to many of you, and as a matter of fact, this was a question that was asked by one of our community members. So if you are not part of our community members, make sure you join. You can always request a video and I'm going to make it available for you guys. So in this video, I'm going to be showing you how you can be able to differentiate if the market is giving a liquidity grab or it is giving you a break-off structure. All right. So, but first and foremost, I'm going to give you the first thing that you need to know when you're analyzing, right? The first thing you need to keep in mind before you start doubting whether this is a liquidity grab or this is a break-off market structure. Now, first and foremost, as I always say on my lessons, is that the market books on liquidity, right? The market books on liquidity. And for you to know where the market is going, you need to know where that liquidity is sitting, right? And now all this means that the trend, or you need to know your institutional order flow. Where are the institutions pushing price to? This is a very, very important thing you need to know first, right? Where is the market driving to? Where is your institutional order flow? And for you to know your institutional order flow, for you to know the overall direction of the markets, you need to be looking at it on the higher time frames. It can be 4-hour, daily time frame, weekly, and so higher, right? So, which means that before you are being confused on your lower time frames, whether this is a grab of liquidity or a break of structure to confirm whatsoever, you need to first of all know where the market is driving to. All right, you need to first of all know where the market is driving to. So if this up here is what we have, if this is our higher time frame, draw on liquidity right up here. Now you need to understand that if the market is supposed to come to this particular area, right? If the market is supposed to come to this particular zone, then let's say the market is somewhere at this point. All right. Let's say the market is trading somewhere here, and then we're expecting it to come up to this level, as this is our main draw on liquidity. Now, the market structure or the movement that the market will take to go up to this point is going to be giving you a clear breakout structure, right? So this is going to be series of breakout structure that the market is giving to you. All right. Now, what if now in the case of the market going up to this higher time frame? Remember, all this, I'm trying to put this structure now in the lower time frame, right? Now, there's going to be a situation where the market will be heading up to our draw on liquidity, and you will notice it taking a low. All right. Now, is this a breakout structure or a liquidity grab? Already with what I first of all mentioned, that you need to first of all know your institutional order flow, know where price is going first before any other thing that you are looking for. All right. And now I'll give you the secret. When the market is bullish, right? When the institutional order flow is bullish, any sweep below a swing low is a trap. Every sweep below a swing low is a turtle soup. All right, this is very important. If the institutional order flow is bullish, if you have price drawing to a higher time frame key level, any sweep below a swing low is called a turtle soup. All right, it's a liquidity grab. So which means that since our institutional order flow here is bullish, price is going to a higher time frame key level. This sweep below this swing low is a turtle soup. Is a turtle soup. Okay, is a total soap. This is a liquidity grab. It is not a break of market structure. It is not a break of market structure. But now, any break above a swing high in line with the institutional order flow, in line with the direction of the higher time frame, that is a valid break of market structure. That is a valid break of market structure. So in case where you see price sweeping a low or taking a low, sometimes it can close with a body, but on a little bit higher time frame is going to be closing with a wick, right? So you just need to know that a sweep below a swing low in a bullish market is a turtle soup. All right. Not to, I don't want to make you more confused. You just have to keep it simple that way. All right. So that you don't start looking whether, because normally, even if you have a liquidity sweep on the 5 minute with a wick, when if you step down to the 1 minute, you are going to see that there's a close or a candle body close below that swing low. All right. So if you want to be looking at it that way, it's going to confuse you the more. You just need to know that any sweep below a swing low in a bullish market is a turtle soap. So here we're having a turtle soap, and what the market is going to do is to continue higher to our draw on liquidity. But now, why do we have this turtle soap here? Why did this turtle soap happen? That's the question too that you need to ask yourself. All right, and then I'm going to let's answer that question right now. Now we have the market pushing higher, right? And then out of a sudden, it takes a swing low. Out of a sudden, we see the market taking a swing low and then continue the trend to the upside. So what actually happened at this point? Why did price take out this swing low? Okay, I think that's the question everybody will be asking. How would you, that is, why will price take out the swing low? Why? Now, this also brings me to this topic that when your institutional order flow is bullish, you also know, as I mentioned earlier, that the market books on liquidity, right? It goes to external range liquidity. When it grabs external, it comes back for internal. Now, this will be in a case where internal range liquidity was not grabbed. Okay. This will be in a situation where internal range liquidity was not taken. Now, internal range liquidity here is formed in the form of order blocks or mitigation blocks or breakers or volume gaps, right? Now, let's say we're having this pullback after price had taken this high, right? We have had our valid break of structure here. We have had our valid break of structure at this point, right? Now, the market gave a pullback. Suppose that we had a fair value gap here, all right, or a mitigation block or volume gap. And this price did not fill this fair value gap. So this means that price did not grab internal range liquidity. Okay, it means price did not grab internal range liquidity. That's why when we have a total soap back here, or we have a sweep below this low, price will actually be reacting to some internal range liquidity that was not grabbed here. All right, so which means that once you have a break of structure and the market pulls back, doesn't clear the internal range liquidity that was in this price range, expect a total soap when price is coming back to this area. This means that if you have another block here, it is likely for the other block to fail, and then price taps into this fair value gap here. And this is the reason why you're going to be having a total soap. So which, now, if you have this in mind, you're going to understand that price can actually close below this swing low with a body, but it will still be a total soap. All right. But now, sometimes you will not just need to engage here blindly. You will want to see price close above the last down close candle that came into this level, right? Making that candle to be another block. So which means as a confirmation, you want to see price close above any bearish candle or the last bearish candle here to validate that it was actually just a sweep of liquidity before you start buying. All right, so this is very important. Remember, you need to first of all know where price is going. If you don't know where price is going, you will assume break of structure everywhere, even in space, even at the middle of anywhere. All right. So, but first, you need to know where the market is driving at. You need to know where the draw on liquidity is so that you will know the type of, you will know whether this is a breakout structure or is going to be a liquidity grab. Just like here, normally, if this was already, if price would have already grabbed liquidity, this will likely mean a breakout structure because it will be reacting to this area. But first and foremost, price was still being pulled to the upside. So which means that any liquidity, any sweep below a swing low that you're having is going to be a turtle soap. It's going to be a for liquidity grab, and the liquidity grab will probably be in the form of a fair value gap or internal range liquidity that was left within the swing low. Okay. So when the market is in a bullish IF, it's going to be rejecting lows and then closing above highs, right? It's going to be breaking highs and rejecting lows just to grab liquidity. Okay, so let's go to the chart and look quickly on some few examples, right? Now, let's say we have, let's look at this area. Now, if you see where I draw these two lines, there was a weekly fair value gap here. That's already means that we're having a higher time frame draw on liquidity, which is the weekly fair value gap. All right, but this is the 15-minute time frame. So we have our weekly fair value gap here, which is going to be our draw on liquidity. All right, now we notice from here that when the market was accumulating here, we will actually, I was expecting what? I was expecting a manipulation This is the accumulation we are having at this point. All right. But now, during this accumulation, what was I expecting? I was expecting price to come back down to this fair value gap or even fill this mitigation block before the buy actually happens, right? But what happened? The market just gave us a push to the upside without grabbing internal range liquidity, that I would say. Okay. The market did not take internal range liquidity. So what were we expecting? If price goes below this swing low now, we are not going to say that it is a break of structure. Even though price closed below this swing low, it is still not a break of structure. Okay, this is just a liquidity sweep. It is not a break of structure because price left internal range liquidity. You can notice that from this swing low to this swing high, this was a fair value gap and the mitigation block that we had here, and price did not feel it. All right, so when price had expanded up, when it was coming back down, we knew that even if it closes below this low, it is not going to be a break of structure. We will not consider that it is a break of structure. Why? First, because the draw on liquidity that we have here is on the higher time frame and it is bullish. All right, our draw on liquidity is higher, so any sweep below a swing low is just a total soap or a liquidity grab or a stop hunt. All right, it is not going to be a break of structure now. So this is going to be our valid break of structure. This is our valid break of structure, right? Because it is in line with the trend. It is in line with the draw on liquidity. And once we have that break of structure, in this case now you can execute on the breaker block or internal range liquidity fair value gap, like what happened here, and then you target the fair value gap. All right, there are so many examples like this. First and foremost, you need to know where price is going. That will make the work a lot easier for you. Know where the market is going. In that direction, you will be able to determine whether if price is sweeping below a swing low or sweeping above a swing high, is going to be a total soap or not. All right. So which means if the drawn liquidity was higher, as the drawn liquidity is higher here, any sweep below a swing low here until price gets to that liquidity, drawn liquidity, is going to be a total soap. All right. So let's see if we'll get some more examples. I think I saw one somewhere around this area. Now, this right here too is another example. We had range here as well. Price was accumulating. All right. After this accumulation, price had left what? Price had left a fair value gap above this area where we had price manipulating into that area before the distribution started. All right. But our focus is not even right back there. Our focus is going to be here. Now, there was a draw on liquidity here on the daily time frame at this level. All right. We had a daily draw on liquidity right down here. Okay. So now what happened is that we know that we are actually bearish. We know that we are actually bearish at this point. All right. So which means that any sweep above a swing high that we can see here is going to be a total soap. So we notice a sweep above this swing high. All right. This is a sweep above this swing high into an internal range liquidity that was not filled here, which is this fair value gap. All right, this is a swing low and this is a swing high. So price swept above a swing high to fill internal range liquidity that was not filled. All right, so what this means is this move here like this is a total soap. This is a liquidity grab here. It is not a break of structure. Okay, now once that liquidity was taken out, the next thing that we had was now a valid break of structure right down here. This was a valid break of structure now. All right. And once you have this valid break of structure at this point, now also you can also confirm your liquidity purge in cases like this. All right. In cases like this, when the market is forming a pattern, because here it's forming an AMD pattern. So you can confirm your liquidity purge when price gives you a real break of structure now in the direction where you're expecting the distribution. So in this case now we had a valid break of structure and then we had price coming back to the OTE here, which is aligning with this fair value gap and also with this breaker. So at this point, this is where you would have gotten your sell, all right? You would have been selling from this fair value gap and then you target the daily draw on liquidity. All right. So this is very simple. You just need to know that where is price being drawn to? Where is price being drawn to? Once you know where price is being drawn to, any sweep that is sweeping above, let's say price is drawn to the downside, every sweep above a high is going to be your liquidity grab. All right. And now it is, as I said, it's going to be a liquidity grab. Now, how would you confirm that it's your liquidity grab? First, the institutional order flow. If the institutional order flow is bearish, then you already have it in mind that this sweep above this swing high is a liquidity grab. And now the next confirmation will be for price to close below a candle's body, all right, to close below the highest bullish candle here, all right, which tapped into that key level. That makes the candle a bearish order block. And also you can wait for a break of structure like what happened here, because I'm saying this because sometimes you might not have had, you will not have a closer break of structure like this one to confirm. Maybe it's going to be right down somewhere and price might give you an entry, all right, the first entry from the other block, and you will miss it because you are waiting right down for a break of structure here. But first thing you need to notice is my draw on liquidity up or down. Once you know where your draw on liquidity is, any sweep above or any sweep below is a break of structure. All right, any sweep above or sweep below, all right, against your additional order flow, against the higher time frame draw on liquidity is a total stop. All right, is a total stop. It is as simple as that. Let me do another textbook setup again. All right, let's study another textbook setup again. So we have a weekly draw on liquidity here. All right, we have a weekly draw on liquidity at this point. Now, this is the 15-minute pushing higher. All right, it is pushing higher into our draw on liquidity, right? From internal to external, internal to external. That's how the market moves, internal to external. Then it comes to internal here. It did not grab internal, and then it comes back. Once it sweeps this low, this is not a reversal signal. Price is simply coming down to grab the internal range liquidity that was unfilled or unrated down here, then to continue the move back to the upside. All right, to the draw on liquidity. So you need to know where you expect break of structure or, but now for me personally, I don't take break of structure that are happening with wicks. I will always want to see a body close above a high. But when it comes to a liquidity grab, it is not so much only about the wicks. Okay, because no matter which chart you see, which time frame you are seeing a wick, if you step down, you are going to see a body close, right? So it is not so much about the wicks when it comes to liquidity grab. You need to know these criteria. Where is the market going? If it is bullish, if it is bearish, then a sweep above or below against that direction is just your normal drawn liquidity grab, because you can take a full body candle, you can form some kind of an institutional candle to then come grab those liquidity low and then price continue higher. Not necessarily just a week, all right? But now you need to confirm it if price starts to now close above those candles before you confirm that this is a liquidity grab to enter your trade. Okay, so if our drawn liquidity is down right here, and then the market grabs this one, and then now our next drawn liquidity is a bearish one here, then price starts its normal trend to the downside, and then it comes down, it doesn't grab the internal range liquidity here, and then it pulls down. Maybe sometimes it will put some equal lows or even a failure swing, and then when it breaks now, this is not a break of structure. First and foremost, it is not happening at any key level. All right, it's just on space, so you don't get to start buying at this point expecting price to move higher. Now, need to know that a sweep above a swing high in a bearish market is a total sold or a liquidity grab. Okay, so you expect price to start selling from here. Now, those who trade total sold stop horns, this is where they are going to be selling above this high, right? Knowing that a sweep bill above this high in a bearish market is a total soap. So guys, that's the end of the lesson that we have for today. So if you have any more questions, if you have any doubts, let me have them on the comment section so that I'll make a video to clarify everything that you are still confused with. All right, so please like the video, subscribe and share to your friends. Let's promote the channel together. Thank you and God bless you.